Hello. This video is going to show you how we can use the new Keynesian short-run macroeconomic model to obtain some numerical results. So let's be a little bit more specific about the goals of this video. We're going to introduce you to a way to work with the short-run new Keynesian model that's more quantitative. So, just to recap, you've already been introduced to the model, the ISRTPC model. You've examined some alternative scenarios where you assumed that certain shocks took place, and your results were displayed in a verbal and graphical way, and that allowed you to discuss the results qualitatively. But now we're ready to take another step. We're ready to obtain quantitative results from the model. Numbers, not just up and down. Now the numbers that you're going to be working with, we're talking about currency units, such as dollars, or we're talking about percentage terms for interest rates or for inflation. Professionals, when they make their estimates, they use numbers. They talk about numbers. You probably want to have a better understanding of what the pros do. The theme here is, how do they get those numbers? So, we start off with several steps. The first step is just to go back to two of our equations that we've been talking about. Our monetary policy model, that's our RT equation, the Real-Taylor rule, and then the IS equation. And we've written both in the form where we have the real interest rate over here on the left-hand side, and then all the factors are over here on the right-hand side. Now, this R here is equal to this R here. So if we want to get an equilibrium, we have to equate them together. So we're going to do that, lop them off and equate them and rearrange them. And when we do that, you're going to get an algebraic expression for the gap. Now this is a big, messy expression, but that's why we break it down into contribution terms. Little tiny pieces. I want to talk about these terms that are here in the numerator. This first term here is the expectations gap. Then we have an aggregate supply shock. Then we have an aggregate demand shock. And then we have discretionary monetary policy. And then down here, we have a big hairy term, but in a second you're going to see that it's actually quite familiar, and it looks like the multiplier that we learned, but it's been augmented with another term that comes from the RT curve, so we're going to call this the augmented multiplier. Now let's skip ahead and let's look a little bit more closely at the augmented multiplier here. What's here? Well, in this numerator here we have our two familiar marginal propensities terms, the marginal propensities to save and the marginal propensities to import. And down here we have our two familiar responses of expenditures, consumption and investment, to changes in the real interest rate. You recall that these are semi-elasticities. And you'll remember that this is actually straight out of the IS curve. And you'll remember that even before we learned about the IS curve, these guys here, the marginal propensity to save and import, were straight out of the Keynesian multiplier. Now, this term is straight out of the RT curve. We're going to actually get a sign for this. Why? Our marginal propensity to save is positive. Our marginal propensity to import is positive. Our responses to the interest rate are negative. We consume less, and especially we invest less when the interest rate goes up. So this whole term over here on the left-hand side is negative. Okay? Let's go over here. Our beta pi minus 1, remember that beta pi has to be greater than 1. That's the Taylor principle. In order for the central bank to do its job and restrain the gap in order to keep inflation down, this guy has to be greater than 1. And in fact, we assume that it's 1.5. So that's going to be positive here. This guy here, this is the elasticity along the short-run aggregate supply with respect to the price level, and that's certainly positive. Supply curves always slope upwards. And then beta gap, remember once again that in accord with its second objective, the central bank needs to stabilize the gap. When the output gap goes up, interest rate goes up, so this guy is positive. So this whole term here is positive. So we have a negative minus a positive, that's even more negative. So our conclusion is that this augmented multiplier must be negative. It is always negative. So now we can go element by element here in the numerator, and we can ask, what do each of these terms mean? Now, first of all, we have the expectations gap. What is the expectations gap? It's the difference between the expected rate of inflation and the central bank's target, where they say they're going. Now, if the central bank has full credibility, this guy is equal to 0. Okay, there's no expectations gap. But if expectations are higher than the target, that means that the central bank lacks credibility. And if the central bank lacks credibility, what a central bank has to do has to respond by raising interest rates to show that, yes, they are a serious central bank and they do want to bring down the inflation rate. You'll notice here that this guy is positive. The beta pi, we already said that. This whole term is negative, so a positive over a negative is a negative, and that tells us, therefore, that when the expectations gap is positive, the gap goes down. Why? Because the central bank responds by raising interest rates and squeezing out demand in order to show that it's a serious central bank. So the effective expectations gap on net is negative. Now, let's look at the aggregate supply shock. We call this a productivity-based shock, PBS, and remember once again that beta pi minus 1, this whole term is positive, and this is negative. But your intuition should tell you that if you have an adverse shock to aggregate supply, the output gap should go down. And then if you have a favorable shock to aggregate supply, then your output gap should go up. So one example of a shock to the short-run aggregate supply curve is the price of oil. If oil prices go up, gap goes down. Oil prices go down, a gap goes up. So now let's make sure that these signs bear us out here. This is positive, this is negative. So you say, well, this is negative, but then we're subtracting it off here. That's what the algebra says. And guess what? That's going to confirm that we will have an overall positive effect here. It does confirm that when we have a favorable shock, a positive shock to PBS, gap goes up. When we have a negative shock and an adverse shock, gap goes down. Now let's look at these aggregate demand shocks. Now, we're treating aggregate demand shocks as if they're all one. So we're including shocks from the private sector, that's consumption, investment. We're including fiscal policy, so let's think about spending, but let's also think about some of the one-off tax measures that we talked about. And we know that, for example, that if we cut taxes, let's say by $1, people will spend more, but they're not going to spend the entirety of that tax cut. They're going to be spending 1 minus the marginal propensity to save out of cyclical income of their tax cut. So that's part of AUT-IS. But then also, we're going to be talking in later chapters about shocks from abroad, net exports, exports minus imports. They're all in here, and we think of them as a shock to aggregate demand. Now, if we have a positive shock, if there's more demand, this guy goes up, and we would expect the gap to increase. And guess what? That we're borne out here on the algebra. Why? Because this term here, this denominator here, we already established it is negative. These are the responses of consumption and investment to changes in the interest rate. When the interest rate goes up, consumption, investment goes down. So that's negative, but that's negative too. So a negative over negative is a positive. We're borne out here. So let's look at our last element here. This is discretionary monetary policy. This one's kind of easy because we're not multiplying it by anything. Now, our intuition should tell us that when our central bank tightens on a discretionary basis, it's squeezing out some aggregate demand, it's squeezing out some consumption and some investment, and that means that the gap should go down. And then if we have a discretionary loosening, that means that the interest rate goes down, our gap should go up. Well, guess what? Our algebra bears us out here because we have 1 implicitly multiplied times our discretionary component divided through by this negative term. So the algebra does confirm our intuition that when we raise the interest rate, the gap goes down, and when we reduce the interest rate, the gap goes up. We're going to split off here, and we're going to see you again in the next part of this video, because this is a long topic.